Hey guys, good evening. Welcome to another exciting session on Stock Simplified. Here I am Tushar again to make things easy and simplified for you when it comes to investing. So let's get started. This is in continuation to our last series. So let's see what we have learned so far. We'll just take a quick revision, then we'll move on. So, what has our journey been so far? We have talked about return on capital employed, a very important ratio greater than equal to 20%. Then we have talked about income growth of greater than 15%. Then we have talked about profits growth of greater than equal to 18%. Then we had debt equity ratio, very important guys, less than equal to 0.3. Then this was a relative ratio in which we compare peer to peer companies EPS growth, where we compare. You remember we in the last video we had a comparison of peer to peer companies. So this is that. Now we have for banks and NBFCs. For banks and NBFCs, there we compare income growth. Here we compare interest growth, the same revenue part greater than equal to 15%. Now we have profits growth greater than equal to 18%. Net NPA to advances. As I told you, this is considered very important as far as banks are concerned. So you really need to take care of this. And again, you have to have a relative comparison in this from year to year. You have to judge it basis the asset quality of a of a bank or an NBFC. Then we had EPS growth. Again, this is the same as I explained earlier. Now, here everything, I'm reiterating this, everything that I mentioned earlier is in continuation for the last 4 years. Remember, guys, I want to make one thing very clear here. There might be 100 different attributes when we look at companies and do fundamental analysis. But trust me, guys, if you understand, till now we did 5 criterias. If you guys understand these 5 criterias really well, if you can analyze every company, you can look at nuances, intricacies, we'll learn those 100 attributes as well. But first we need to look at these 5 integrators primarily. And trust me guys, if you understand these, 95% of the work is done. So today we're going to start with our criteria number 6 to reach our 99th level. So let's get started. What is our criteria? Criteria number 6 is PE ratio. Now PE ratio, guys, what is it? It is price to income ratio. Now let's just define PE ratio. What is PE ratio? It is just a ratio of the market price of a share versus the EPS of the share. EPS, you know guys, we did in the last session. What is market price? Let's look at this by an example. For example, the market price of any share XYZ of any company is 1000 rupees. The EPS is 50 rupees. Where did we get the EPS from? We got the EPS from the profit and loss statement. The EPS is 1000 by 50, simple maths, it's 20. Now let's look at why PE ratio. Obviously we are studying this, but we need to know the reason that why are we studying PE ratio. How many of you here are whiskey lovers? Let's say we have a peg of whiskey. In a peg of whiskey, what do you guys choose? One part of whiskey, correct? While making a peg, you have three parts of water or soda or one part of whiskey. Consider a situation in which you have a tub full of, say, soda or water, and you have just this small peg of whiskey. Will that taste to you? You got my point? That will not even taste like water. So what is the relevance here is we're going to explain this further. Consider whiskey as the EPS and water the price. So if just try and relate what I'm trying to say here. If the price is very high and EPS is very low, that means the earning is very low, and price is very high, that means there is some sentiment driven in the stock price of a company and it rises exponentially. But we know that the EPS is low. Then we can say that if the ratio comes higher, we can say that the company is expensive. Now, what is expensive? In stock market, what do we consider as a good PE ratio? Like the ratio of price to the ratio of EPS. You can just pause the video if you like, but you can just ponder over it. Okay, shall we continue? Again, guys, it is relative. The correct answer it is relative. Why? We compare PE ratios of two companies in the same sector. Why the same sector? You're going to compare a male with a male, and not in terms of strength, and not a male with a female. Correct? Now, let's look at an example. In comparing two banks, say bank one, the price, current market price is 3,000 rupees. The EPS is 50 rupees for one share. What is the PE? PE is nothing but 3,000 divided by 50. It comes, the PE is 60. Okay. In the second scenario, the price is 800 rupees, EPS is 12 rupees, and PE is 66 rupees. Now, if I ask you a question that what do you think, which is an expensive strip? Like currently, I want to take a position in bank one or bank two. Which share are you going to consider more expensive? Layman will say, obviously, sir, I'm going to pay 3,000 rupees for a single share. I'll buy this 800 rupees share, that is more, that is a little cheap than, as compared to the other one. But remember one thing, here we have compared price with the EPS. So a share is expensive and a share is less expensive. Here, the less expensive share. Which bank is more expensive? Bank 2 is more expensive despite low prices, since the EPS is low. Now here, consider EPS as the whiskey and price as water. EPS is this much, price is this much. So will we take that company into consideration where the company's price are really inflated in terms of the market? So here we have to value a company before taking any decision for investing in that particular company. So here, if we want to conclude, we can say that irrespective of the current market price of a stock, only that script is considered expensive or cheap when we equate it with the EPS. We have to, at some point of time, there has to be a mathematical equation between the two. So when we equate price with the EPS and compare it to the same peers, I have highlighted the same EPS and peers. This is very important. But I was just wondering, did we miss anything here? We have considered the market price. We have considered the earnings per share. Earnings per share is a component of net profit after tax upon the total number of shareholders. So here a point to consider is, if bank 1 is growing at 16% per annum, we have taken like the criterias that I've given before. Bank 1 has grown at 16% per annum, means this is also in my list. And bank 2 has grown at 33% per annum. The average that I'm taking, this is a hypothetical example, but the average that I'm taking is for the last 4 years. Now I'm again in a dilemma. The bank that I'm considering expensive is now suddenly looking cheap. How will we justify this? We will justify this when we move forward. So we think that we missed something with price, with the earnings per share. We have to consider third important thing, that is a very important point to consider. What did we miss? We missed something. And what did we miss? We missed the growth factor. How can we say that a company, you guys, do you get the point? Are you able to relate? How can we say that a company is more expensive than the other when we ignore growth? So we think that we need to learn a little further than PE. Now let's consider another concept. From PE, we move on to PEG. Now what is this PEG? PEG is nothing but PE ratio divided by the growth. Sounds fair enough. PE takes care of the price, the EPS. Now we are equating it with the growth. So it is going to be a jackpot ratio for us, guys. Now, what is earning growth here? Earning growth here is year on year growth in terms of income growth in terms of banks and revenue growth in terms of companies other than banks. This I've explained earlier, that income growth and revenue growth, how are they different, and so on and so forth. Now, let's go to our previous example. Bank 1, the PE that we had taken was 60. The growth was 16. Now, what is the PG? PG is 16 by 60 by 16. That comes down to 3.75. This share, we said that this share looks a little less expensive and we can take a position in it, but it was growing at a rate of 16%. Now we go to the other bank. The PE was 66. It was commanding a higher PE, but the growth was 33%. Now if I go to the PEG, the PEG ratio comes out to be 66 divided by 33, it is 2. Now you guys understood that price and earning per share, that may be high, but when we equate it with the growth, Bank 1 is not able to justify it with the kind of growth that it is making. Means the future prospects look a little bleak. It is growing at 16% per annum. The other is growing at 33% per annum. So what do we say? Which is a less expensive stock? The less expensive stock is winner Bank B, who is a clear winner in this case. You guys, this is a very, very, very important concept of PEG. We always calculate this before we invest. Now let's move forward. What is the learning point? Learning point here is you have to always include growth while valuing a company for investment. Always remember, the growth of a company will take your stock prices exponentially very high. Imagine people who have invested in companies like Infosys when they started. Those companies grew at humongous rates and they have given exponential returns to the investors. So growth is a very important factor. With PE, you have to consider PEG. Now let's get a little forward. While picking up any company, I specifically wanted to highlight this. While picking up any company for investment, when you have assessed the previous criteria that I have given in my last 4 videos, that I'm not again going to reiterate this because we have already revised it. Always choose companies whose growth is higher and PEG is nearer or less than 1. Very, very important. This is as important as ROCE, guys. So you will pick up good companies, you will pick up good investments, you will make good decisions. And now I don't think so any Tom, Dick and Harry can come and tell you that, dude, invest in this company. You will have that understanding of income, you will have that understanding of growth, you will have that understanding of how to look at companies, how to compare it to the peers. So guys, this was it for this session. In the next session, I think that we will take up another concept, or before taking up another concept, we would like to first apply the concepts that we have discussed so far with the real time on a company of your choice. If you guys want me to analyze a company of your choice, please post that in the comment section. Rest, I think that we are making the things simplified in terms of investing and it doesn't look a gamble anymore. So this is it, and thank you guys. And if you really like the video, please like, share, subscribe, and we'll catch up again on Stock Simplified. Thank you so much, and bye bye. Good night.